Good morning. Grab your coffee. Let's get started. Good morning and happy Wednesday. And if you've been outside, it's raining. It's nice. It's not hot. It's really nice. So I'm going to be out showing condos today. So I hope it's not much of a downpour. Sometimes you get in these condo complexes and they give you the number for the unit and you have no idea where it is. And so you're wandering around getting rained on most of the morning. But where are we at today? So we are sitting at 6,072 listings. That's down about 200 from yesterday, maybe a little less. 4301 came on the market over the past 7 days with 3,867 going under contract. That's a difference of 434, and it looks like this over yonder. Again, the blue line is the number of listings that have come up the past 7 days, and the yellow lines are the ones going under contract. 4th of July was here, kind of making the numbers a little muddy, so you can see that the homes coming under contract are starting to come up. That's what we want. That's a good thing. Good morning, Terry. Glad you made it. Got a seat. Good. Hope it's a good seat. So I started the title with comparing some numbers of 2008, and we're going to look at a couple things. But I want to caution people that, chart analysis is not something you want to do in real estate. That's something you want to do in stocks and commodities. So, because there's too many factors in real estate. And then, you know how I like to cruise the news. So I like to look at the headlines and then look at the reality. So we've got a couple of them here I'm going to jump over to real quick. And that is this one here that says Redfin reports new listings of home for sale surpass 2019 levels. That's interesting. Let's see what that looks like. Nope, we haven't surpassed 2019 levels. We're right here. 2021, up here's 2019. I mean, wouldn't you like to be sitting with 15,000 homes on the market today? And maybe that's happening in some parts of the country, according to Redfin, but we're not seeing it. Are we going to catch up with the rest of the country? Well, this thing is acting on the same trajectory as you see with this line here, which is 2005. And they rather rapidly went way up to record levels in just a few months. From July to December, boom, there they were. I'd be tickled pink if we ended up July to December at 12,000 units. I mean, that would be great, because then you won't have any bidding wars and you can still get your house sold. So I know right now that buyers just want this nightmare to be over. They want the bidding wars to stop. They want all the silliness and the craziness to be over. Sellers still want to be able to get top dollar, but many sellers are sitting on the fence because they know if they sell, they're probably not going to find the house they want. So all of that goes away if we get closer to balance, but it's so hard to figure it out right now. I mean, here's another one. This is an interesting little article here. Weekly mortgage refinances spiked 20% after an interest rate drop to February low. Mortgage applications to purchase a home rose 8% for the week, but were 29% down versus a year ago. When you dig into it, mortgage application volume bounces back, refi shares up 20%. It says, though, the seasonally adjusted purchase index increased 8% from 1 week earlier, but was down 13% before the adjustment and was 29% lower than the same period 1 year ago. So what they're saying is that they're comparing this week to last week, and we went up 8%. But if you compare it to last year, we're still way down in mortgage applications. So there's always a little devil in the details when it comes to these headlines. So I always like to do a little bit of digging. The Cromford Market Index, which is a measurement that they use, which is proprietary. I don't know exactly how they do it, but I know that it's very accurate in predicting in the short term and midterm what's going on with the market. And as you can see, we're declining, right? So the index is declining, but a normal market is 100, which was last seen in 2005. down here. Well, actually, we're at 86 down there, but here is the same trajectory comparing to 2005. Where are we comparing 2019? Because 2020 doesn't count. That was just a mess. But 2019, if we layer that month in, that year, we were still starting to come up around 140. And in 2020, everything changed. So March, we dropped significantly. You're all told to stay home. And then people said, wait, I don't like this. I think I'm going to go out and get a house because interest rates are lower. And bam, the market took off. Here we are. We peaked here in March with a market index of 514, unprecedented. Now, I remember when we got about 300, all of us real estate agents are like, what the heck is going on here? This is crazy. And then we pop up another 200 basis points. It's crazy. So to put it in perspective, we see this line coming down, but we're still sitting here in a market index slightly below 400, and we're pretending that things are really leveling out. Well, they are coming down, and they are coming down slowly. The active listings are coming up slowly, but we're still in seller territory. It's still nuts. So there's hope. There's hope on the horizon, but I don't know. We're just going to continue to look at these numbers. Now, so to recap, we kind of looked at the mortgage application volume dipped. We're looking at the Cromford market index going down. We're looking at inventory coming up. And then there's some cities. These are the cities with the biggest share of homeowners in danger of foreclosure. Now, again, this is a headline. I'm going to kind of just point out a couple things in this headline. One is that the percentage of homes that are in some type of forbearance plan or behind on their mortgages is the first number that you look at. Then we get in and see how big of a problem is this going to be. So let's see what these folks are saying. And I think this is from MarketWatch. No, this is Realtor.com. Oh, it is a MarketWatch article, so I was correct. If a modification is unable to address the delinquency, the next option for the borrower is to sell the home. And he said, given the rapid level of home appreciation, this alternative should allow many distressed homeowners to avoid foreclosure, pay off the mortgage, cover selling expenses, and maintain one's credit record. So we've been saying that for a long time, that, if you're in a scenario where you can't get caught up and you can't modify your loan because you get out of forbearance, you still owe some money, right? So what they're going to try and do is tack it on to the end of your loan, maybe extend the terms of your loan. But if you're in a position where none of that's going to work for you, or they're not going to let you do it, you can always sell your home because you've got equity. Now, not everybody's going to have equity, but the majority will. Atlanta tops the list with 17.4% of the city's mortgages in delinquency as of May. The city also has a large share of FHA loans overall, with those loans representing over a fifth of all the mortgages in the city. Now, we aren't on the list. And down here you see Atlanta, 17.4%. Percentages of loans in serious delinquency, 12.8%. So serious is anything considered 90 days or more out. And then we have Chicago, Naperville, Evanston, Illinois, and then down here Philadelphia and Pennsylvania. But a lot of Texas places here: Great Butte, Fort Worth, San Antonio, New Braunfels. Let's see, New Braunfels. That's yours, Todd. Let's see. Here's Dallas, Plano, Irving. What's going on in Texas? Woodland, Sugar Land, Texas, Houston. So a lot of Texas people. But what they're saying is that, there's 11.1% of the mortgages here in, let's see, it says California, but it doesn't make sense right there. San Antonio, 11.1% of the mortgages are in serious delinquency. So you have to take that kind of with a grain of salt and say, okay, 11% of the mortgages are 90 days late. How many of those, when they exit their forbearance plan, are going to be able to readjust their note? And from what we're seeing when Black Knight tracks all this stuff, is that the majority right now are exiting their plans and they have a new modified loan, or they just caught up with their payments. So is that 11.1% going to stay at 11.1 seriously delinquent? I kind of doubt it. based on what we're seeing with Black Knight, if it gets down to about 5%, then maybe 5% of the mortgages do end up hitting the market. So they're going to go up for sale. That will help inventory. And then the number that'll end up in foreclosure diminishes even further as you look at that. So I still don't see that as being a red flag. And it also looks to be very regionalized. So I think, hey, thank you guys, Tyler. This guy's got the tech data and the real estate street smarts. I appreciate that. This is kind of fun. This is really fun for me. I feel like I'm getting to know a lot of you. I went and showed a condo the other day, and I pulled up in the truck, and the clients were standing out in front of me, and they're looking at me and smiling. I had no idea who they were. So you guys get to know what I look like, and I don't have a clue. So I think that what we're going to see is there's a little bit of a bounce back here. And that is that when I look at this chart here, and I know it's just a holiday week, but here's the yellow one. These are, homes that went under contract. Now it's still below what we've been seeing, or it's a little, way over here. But, if that springs back, that's what I'm curious about. And that's what I really want to watch, is that if inventory starts climbing like it is, and it gets up to where bidding wars start to subside, will buyers just open the floodgates and come back out? I think it's possible. And the numbers will tell us if it's really happening. But yet, I'm looking at the national numbers, and Redfin's saying that most of the country is all the way back to 2019 inventory. I'm a little suspicious of that. I don't have the data to look at the rest of the country when I know we look at it here in Arizona. We're not even close. But if that happens and then things level out and rates continue to stay low, I just don't see buyers staying out. Buyers are staying out not because they can't afford the house. They're staying out because they can't afford to lump all this cash out there to compete with the cash investors and to try and waive appraisals. I think they're going to be ready to go back out and start purchasing once we hit a balanced market. And that's what I want to watch between now and Christmas. So I think that's going to be the breakout time for us. I think that's going to be a game changer. So, those are the numbers that we're going to watch. So, hey, take on Wednesday and have a good time. And I'm going to be out showing homes today. And stay dry. And go Suns. I thought they were playing last night. They're playing tonight. Have a great hump day. See ya.